When we hear that a company is profitable, we immediately think successful, right? We picture them just rolling in cash. But what if I told you a company could be reporting record profits and still be just weeks away from going bankrupt? It happens more often than you think. And today we're going to dive into that surprising truth, the critical and often misunderstood difference between making a profit and actually having cash in the bank. So what's the secret sauce? Well, it all boils down to one simple but super important word: liquidity. You have to forget what a company is worth on paper for a second. Liquidity is all about the here and now. Can you get your hands on cash when you need it to pay the bills? It's not just some metric on a spreadsheet. It's a company's financial pulse. And hey, this isn't some made-up classroom example. This is exactly what happened to Lehman Brothers back in 2008. Their books showed over $639 billion in assets. So how on earth does a giant like that just collapse? Well, to find the answer, we have to start by understanding what profit actually means to an accountant. All right, so let's start with how companies figure out their profit. It's not just a guess, it's a really specific process they go through at the end of every accounting period. Like a month or a quarter or a year. It's where they officially tally up the final score.
Honestly, the best way to get your head around this is to think of it like a scoreboard at a big game. When that final whistle blows, you look up to see the final score, right? You see who won. But then, before the next game can start, what do you have to do? You have to reset that scoreboard back to zero. Accounting works pretty much the exact same way.
Okay, so this might look a little complicated, but stick with me. This is the accounting cycle. It's the whole playbook that businesses use to track their performance. Now, don't get bogged down in all the details. The main thing to see is that all these steps are leading to one thing: creating those final financial reports. And that scoreboard reset we were just talking about, that happens right here in a step called closing entries. Closing entries is really just the official accounting term for hitting that reset button. They take all the temporary accounts for that period, things like your revenues and all your expenses, and they zero them out. This process draws a really clear line in the sand. It says, okay, this is the profit we made in this specific time frame, and that's it. And it's not as complex as it might seem. It really just boils down to 4 main steps. You add up your revenues, you subtract all your expenses to get your net income, and then you account for any money paid out to the owners. Once that's done, boom, the scoreboard is officially reset and you're ready to start the next period fresh. Okay, so that's profit. It's a measure of past performance. It's looking at the game that just ended. But what about a company's health, like right this second? That brings us to the other side of the coin. It's time for a liquidity checkup, a check of its financial pulse. And that pulse, as we said, is called liquidity. It is, at its core, a measure of survival. Can the company take the stuff it owns, its assets, and turn it into actual cash fast enough to pay the bills that are due this month? That's the one crucial question that liquidity answers. So how do you take that pulse? Well, one of the quickest ways is by calculating something called working capital. It's simple. You take your current assets, that stuff you can pretty easily turn into cash within a year, and you subtract your current liabilities, which are the bills you have to pay within a year. You really want that number to be positive. A positive number means you've got a nice little safety cushion. But just looking at a raw dollar amount, well, it doesn't always tell the whole story, right? Especially when you're comparing a huge corporation to a small mom and pop shop. That's why an even more useful tool is the current ratio. It uses the same 2 numbers, but instead of subtracting, it divides them. This gives you a really simple ratio that tells you, for every $1 of debt you owe right now, how many dollars of assets you have ready to go. Anything over 1 is generally a good sign. Let's make this real. Take a look at this example, a company called Printing Plus. They've got about $26,500 in current assets and only about $5,400 in current liabilities. That gives them a current ratio of 4.91. Wow, that is fantastic. It means they have nearly $5 of easy-to-access assets for every single dollar of debt they need to pay soon. That is a very, very healthy financial pulse. All right, so now we've got both pieces of the puzzle, right? We have profit, the historical score, and we have liquidity, the real-time health check. So now we can finally solve the paradox we started with. I mean, when you put them side by side like this, the difference is just night and day. Profit is a historical record of performance. Liquidity, that's a real-time measure of survival. Profit is what you've earned. Liquidity is what you can spend right now. One looks at the past, and the other is totally focused on the present.
They're just measuring two fundamentally different things.
So why? Why does this big gap between profit and cash even exist? It all comes down to a really common business practice called accrual accounting. And here's the key. With accrual accounting, a company records revenue the moment a sale is made, not when they actually get the cash. So you could send a client an invoice for $1 million and immediately book that as $1 million in profitable revenue, even while your bank account is totally empty.
And, don't think for a second this is just some weird issue for giant corporations. It's not. Look at this statistic. 1 out of every 4 small businesses that fail because of this exact problem: cash flow issues. They look profitable on paper, but they literally run out of money to pay their people and keep the lights on. Which brings us full circle, right back to Lehman Brothers. They owned billions in assets, things like complicated mortgage-backed securities. On paper, these assets were worth a ton, but when their short-term bills started coming due, they couldn't sell those assets for cold, hard cash quickly enough. It wasn't a profit crisis. It was a massive liquidity crisis.
And that right there is the single most important thing to take away from all of this. I'll say it again. Profit does not equal cash. A company's income statement can paint this beautiful picture of success and healthy profits, all while its bank account is dangerously close to zero. You have to look at both.
So the next time you're looking at a company's finances, or maybe even your own business, don't just ask, is it profitable? You have to also ask, is it liquid? Because as we've just seen, those answers aren't always the same. And knowing the difference, well, that can be the difference between success and failure.